Hi, my name is Brian Smith, and we're going to go over principles, assumptions, and constraints in this snippet. So, the first principle that we want to talk about is the measurement or cost principle. And what this principle basically says is that we are going to measure our transactions based on the cash value or the whatever value that cash would have been expended had cash been involved. So, for example, if you have a service or a good that you acquire, you will record it at the cash amount that you believe that you'll be spending on it or the equivalent value of that product or service. The next principle is the revenue recognition principle. The revenue recognition principle is going to identify any revenue that we have earned in the accounting period that we earned it in, not necessarily when we have received the cash. So, for example, if I've done the work for somebody, let's say I have a landscape business and I've done the work, but they're going to pay me later, I need to record it in the day or in the month that I have I did the work. So let's say if this were July and I did the work and finished it in July, but I don't get the money until August, I still have to record it in July. That's when I finished the work. And the expense recognition principle is the next one, and it's very similar to the revenue recognition principle in that we are going to recognize our expenses in the month or in the accounting period in which we've used them. So, for example, if I have a business that has a house or a office in a building, I'm going to use utilities to cover our electricity and things like that that we're going to have to pay. So I'm going to expense that electricity in the month in which I use that electricity, not necessarily when I got the bill and not necessarily when I made the payment. So, for example, I might get the bill. Let's say, let's use July again as the same month. Let's say I used electricity in the month of July and I get the bill August 2nd or August 3rd for July. Well, I'm going to record that bill as having, even though I received it later, I'm going to record it in July, showing that that electricity was in the month of July that I used it in. Even if I pay for it later on in August, we're still going to record that as an expense in July. And then the last principle we're going to talk about is the full disclosure principle. The full disclosure principle states that basically we are going to disclose any information, whether it's good or bad, if we believe or if any reasonable person believes that it will impact the decision making of an investor or other external entity, such as a banker or some loan person. So if I know I'm in a lawsuit and I believe that I'm going to lose that lawsuit and have to pay a lot of money, if I don't disclose that, then that's going to get me in trouble. It's not following the full disclosure principle. I have to release that information in my financial statements. So the assumptions, now we're going to start with assumptions. The first one is the going concern. This is kind of a funny worded one because it really doesn't go along with much of what we're going to talk about on it. The going concern assumption is we assume our company is going to continue operations for the foreseeable future. We're not going bankrupt and we're not going to be sold or taken over. All right. So our going concern is that we believe that we're going to continue operating as is in the foreseeable future. Then there's the monetary unit assumption, and that monetary unit assumption is that we believe that, or that we are going to annotate all of our financial information consistently. So, for example, in the United States, following the United States Generally Accepted Accounting Principles, or GAAP, we are going to list all of our financial information in the US dollar. This primarily is a concern for multinational companies or companies that are traded on stock markets in other countries where they may have to translate or convert their financial information to the local currency. So if we have a company from Canada listed on our stock exchange and they have to file their documents with the SEC, they should be doing it at least consistently, even if it's the Canadian dollar. But in reality, they should, for simplicity, presented in the United States dollar. Then there's the time period assumption. We assume that a business can be broken up into certain time periods. For example, we can break it up into months, quarters, years, that kind of a time frame. That's what we typically look at in an accounting period. Very rarely do we go into half years or into an 18-month cycle, although those do happen occasionally. But primarily speaking, we're going to focus on the time periods of a month, a quarter, or a year. And then the last assumption is the business entity assumption. This is that we assume that this business entity's financial information is distinctly and solely that business entity's. The owner of the company is not going to mix their personal finances with it, nor are any other business information going to be included in that accounting or in that company's financial information that's being presented. Otherwise, we would have a kind of a big jambalaya of information that we wouldn't know which is which. So we assume, as part of this assumption, that the business entity we're looking at is solely that business information and not anyone else's. And then we're going to talk about two cost constraints now. The first one is the cost benefit constraint. So what we're going to do with the cost benefit constraint is if we could do things more efficiently, but it costs us too much to derive that benefit, we don't have to do it. Typically in accounting, we have to do certain things that require us to present things fairly and in a good way. But if the cost outweighs the benefit, and by cost, the money amount that it would take to get that information outweighs the benefit of what it would be, we don't have to disclose it or we don't have to do it. So let me give you an example of this one. It's kind of a little bit tougher to grasp. If we found out that there was potential fraud in the amount of $100 and our entire operations are in the billions of dollars, the cost that it would take for us to find out what happened and how it happened would cost us, say, $100,000 to get a forensic team in there to look at everything and to give us a report. The cost is going to outweigh the benefit because nobody's going to care about $100 in a billion-dollar company. These things happen, and as long as it doesn't repeat over and over again, we're probably good, all right? But if it's $100,000 that was potentially stolen, and it would take us $10,000, suddenly the cost no longer outweighs that benefit. So that's the analysis we have to look at. Would somebody really want to know this information? And if so, what benefit is derived from that and what cost is going to be having to be incurred in that? Now, the materiality constraint is the last one, and it's very similar to the cost benefit in that, in the same example, if somebody steals $100 from a billion-dollar company, we don't have to deal with it. We don't have to think about it. We don't have to disclose it. It's just, who cares? We're moving on. Because it's so small, so minute, and it's not going to impact any financial statement users' decision making abilities, that we're probably not, it's not material. We call it immaterial, okay? But material means it's very important. And so what we have to do is that if someone steals $100,000 from our company, then we're going to have to let people know about it because that's a lot of money, all right? $100,000 for even a billion-dollar company, there's something went wrong. We have to disclose that $100,000 was stolen. We'll have to look into it because it is a material situation. So that's it. Those are your principles, assumptions, and constraints. I hope this helped. Have a great one, and we'll see you in the next snippet.